Well, welcome to week 7. We finally made it. Not too much left. Week 7 assignments in week 8, and we're getting through the home stretch. But we'll talk about performance evaluations today. So the first thing to take a look at, I have some financial statements here. Very simplified, very condensed financials for a company, just a random company. And you can see here we've got 15 and 16, two numbers. And you can see there's some growth here between the numbers. Their sales numbers went up a lot, 2.8 million between the 2 years. Cost of goods sold also goes up, of course, because sales go up. Other expenses go up accordingly. Depreciation goes up a lot, which should tell me there's a big addition to property, plant, and equipment. And then you get down to operating costs. EBIT, which stands for earnings before interest and tax. And you can see that even though sales grew a lot for the company, the EBIT actually went down, so that's not a good sign. And then even after that, because looks like they financed, most likely, they financed the property, plant, and equipment with debt. And I'm guessing that because interest goes up a lot, and now they have negative earnings, and then tax after tax, everything else they went from a positive to a negative. That's typically not a good sign. So total assets are right here. You can see that cash goes down a bit, short terms goes down, accounts receivable goes up a lot, as does inventory, which isn't unusual when you have a lot of sales. The question is, should they go up in proportion to the sales? But AR, which is account receivable, and inventory both go up a lot. And right here, gross FA stands for fixed assets. That more than doubled, which is not surprising based on the depreciation number going up. CA stands for current assets, and current means 1 year or less. And then we subtract depreciation from fixed assets, and we have a lot of depreciation because we have more assets to depreciate. The net FA is just simply the cost minus depreciation. So net FA. Fixed assets or property, plant, and equipment. Total assets almost doubled, very, very close to doubling. Then we get to liabilities and equity, and accounts payable goes up. Again, probably not terribly unusual for the amount of sales that went up. Notes payable goes up. That's money we borrowed. It goes up by 520. Accruals goes up, which makes sense with sales going up. Accruals kind of tend to grow with them also. Then look at the debt, 323 to $1 million. So they borrowed 520 in short term and 675-ish in long term. So a lot of debt was taken on by the company in a short amount of time. Common stock stayed the same, which tells me they did not issue any new stock for the year, and retained earnings goes down because we had a net loss. So if you can recall, if you had an accounting class, one thing you might remember is the fact that retained earnings goes up for net income, it goes down for net losses, and it goes down for dividends paid. Okay, so we can see, and of course it has to balance. We have the same numbers here as we did on the previous page of the balance sheet. Then we get to cash flows, and cash flow is organized into 3 broad categories: operating, investing, and financing. And operating is really about taking your net income and adjusting it for non-cash items to get down to a cash either provided by or used by your operations. What do you do on a day-to-day basis? Now, we don't know what this company does. It's kind of made up company, but imagine it was a retailer. Imagine it's a grocery store. Let's pick that. Let's pick something everybody knows what that is. And so we all know what the operations of a grocery store are. A grocery store is buying finished goods from suppliers, food manufacturers, ordering those items. They get delivered to the store. The store puts them on the shelf. You and I go in and buy them. Okay, so that would be the operations of that store. That's what it does on a day-to-day basis, and that should generate cash. Okay, ideally that produces positive cash. And you can see here for our company, it did not. Okay, we have a very large negative amount of cash from our operations, which is not a good sign. The investing category is typically when companies buy long-term assets, property, plant, and equipment type assets, and you can see here FA is for fixed assets, so a large negative, and which is not untypical. We know that they borrowed a lot of fixed assets, so they borrowed money, bought fixed assets. In the previous screen, some of the bigger culprits here was the change in account receivable and the change in inventory. Both numbers went up a lot. Okay, then we get to financing, and financing shows money you borrowed, money you paid back, dividends paid are usually typically the biggest ones. So change in notes payable, we increased that, we borrowed more note payable, we borrowed more long-term debt, and they paid a little bit in dividends. And so that's a big positive, which we kind of knew. That big positive there paid for the fixed asset investment here, and it helped us cover our operating losses here. And then they show us the sum of all of those right here. So all three categories here, that reconciles to my net change in cash. So cash at the end was 7282. At the beginning of the year it was 9. The change, the difference is the 1718. So now the cash flow statement itself is not how you calculate free cash flow. I don't mean to confuse you by that. I just wanted you to see some basic financials, because this chapter is about performance measurement. How did we do, and how can we measure the performance of the company? Now, the chapter speaks mostly to items that really don't involve financial statements. Okay, in finance, cash is king. We focus on cash produced and some other things like that. Accounting is historical in nature, of course. It's saying, here's how the company did last year. At this point in time where we are in late February, a lot of companies are now getting done with their year-end financials, issuing those and saying, here's how we did as of the year ended December 31st. So they show you the financials that we just looked at. An income statement, a balance sheet, a statement of cash flows. Here's how we did based on accounting rules, what they call GAAP, Generally Accepted Accounting Principles, GAAP. That's GAAP. Okay, and GAAP's main goal is the proper measurement of revenues to expenses in the same accounting period. That's the whole reason for it existing. So in GAAP, in accounting, if you can recall a few rules, you can earn a revenue without actually receiving the cash at the same time, and you can incur an expense without having paid the cash at the same time. So it's more focused on the process of revenues and when we earn a revenue and when we incur an expense. That's really the main goal. But our class is finance, and so we learn other performance measurements using the financials. That's why I showed you financials. I still need those, but I'm going to make adjustments to them to help me do other calculations that in finance we would say might be more meaningful. Okay, so that's the purpose of showing you those. So the next concept is free cash flow, which is not the cash flow statement, believe it or not. It's a calculation that says, here's how much cash is available to distributions to investors. And it says here that would include stockholders and debt holders after making necessary investment to support operations. Okay. Now, a company's value then is dependent on how much free cash flow can you generate. Obviously, the more you produce, the better. Your company is worth more. So think of free cash flow like this. An example I like to use is, do things wear out? And the answer should obviously be, yeah. You buy a car, it won't last forever unless you put a lot of money into it, right? You have to, maintenance, repairs continuously for it to keep working. At some point in time, you're just like, well, the maintenance is more than this thing is worth, so I'm going to buy a new vehicle. That's usually where you get to the point of. And it's no different in business. If I'm a manufacturer and I make something, and I have a factory, I have machinery, I have all this property, plant, and equipment that I need to manufacture my product. Then also think about technology. Technology changes all the time with increased technology, computerization. If I'm a manufacturer, there's a really good chance that an increased investment in property, plant, and equipment might actually pay for itself because of the automation. A great example is where I live, there's a local small dairy, and small would probably be like 300 and some head of dairy cattle. This dairy, they were spending so much time milking cows, the labor part of it, and it was small enough that the farmers couldn't really afford to hire that many people to help out. So the owners, the farmers, were the ones doing the milking. It takes a tremendously long time to do that. Well, they decided, what if we automate? And they did some research and discovered that there's a European company that sells automated cow milkers, believe it or not. So it's this very large stall, and with laser guided equipment, the cows are chipped. They're RFID chipped. They wear a collar with a chip, so the computer knows which cow is which. And the cows get trained that if they walk into this area, they get a treat. It's kind of like training a dog. And if they walk into this, the gate shuts and they get a treat, so they can chew on this treat. It's kind of chewy, so it takes a while to eat it. So while they're eating that, they automatically get milked. And just there's later a laser guided system that puts everything where it needs to be to milk a cow. And they have to milk so many times per day, and so on. So now with automation, they're not spending their time milking cows all day, and better yet, they know which cows produce how much milk. And now they've got all this data about every single cow and its production abilities and so on. So it's just, so not only did I automate and save a ton of time, I now have all this data that helps me manage my dairy herd better and increase the efficiency of the amount of milk that I'm getting from each cow, which obviously is important if you're going to make money. So now this dairy spends all their time growing, and they vertically integrated. Now they bought a store to sell their own goods. They make their own ice cream, make their own milk, make their own cheese. They just decided to go from all levels of operation. We're going to grow our own feed it to our cows, milk them, process our own milk, our own cheese, our own ice cream, get a store open, sell it. So because the farmers took the time and took the risk and the jump to buy this equipment, all of a sudden they've got all this time to think about growing their business. So that's an example of my whole point about that was to say free cash flow is money left over after investment. So you look back at your company and you go, okay, what kind of investment did we make or do we need to make just to maintain operations? So as I look back, I have to think, okay, not only did we hopefully generate cash, but I got to think about, I had to invest some money into operations. So cash left over is cash that I could take out of the business and maintain current capacity. Okay, so think of it like this. Any cash I can take out, but my capacity is the same. Okay. Now, rarely would you ever dividend away all your free cash flow. That would not be ideal. We had a whole unit a while ago about payouts and how much money you pay out to your investors and whatnot as dividends or stock repurchases. But free cash flow is how much cash your company can generate and still operate efficiently and have enough money for investment and whatnot. But then the value of a company is essentially the present value of all future cash flows. So what can cash flow be used for? We can pay off debt. We can pay interest. If I paid back debt early, I save future interest payments. Of course, we talked about you can pay a dividend, buy back your stock, and grow the business. Now all of a sudden, if I'm producing cash flow, now I can reinvest back into myself, or I can just park that money in investments, in stocks, bonds, something, just to let it sit there and percolate and grow for some future use. So here's the calculation for producing free cash flow, or how to compute it. Now, I should tell you that the assignments this week, there's actually a little bit more than there has been in some weeks. There is a traditional quiz. I've been giving you roughly 10 question quizzes. That's there. There is a discussion board post, like there has been for most weeks, although it's not a hard one. It's just defining a couple of concepts. And then there is an Excel file that I'm going to have you complete, 5 questions, and then once you complete the Excel file, you would go and do the Excel quiz in Blackboard. And basically once you think you got the right answer in the Excel file, you would go over, for all 5 questions, you would go over into Blackboard, open that particular assignment, and type in or select the right answers. It's multiple choice, and the right answer is one of the options to choose from. So anyway, but calculating free cash flow is one of the questions. Okay, so that's why I'm going to kind of just focus on the screen here and think about the 5 steps to do that. Is number 1, you have to compute what they call net operating profit after tax, which is called NOPAT, N-O-P-A-T, net operating profit after tax. So take your earnings before interest and tax times 1 minus T, 1 minus the tax rate, and you get that number. Okay, that's one way to do it. Okay, and that's an easy way to do it, and that's the way you'll be doing it for the quiz. Now, another way to do it, which you're not doing, is this one on the right, because the questions that I gave you show you earning. You either already know what the NOPAT is, or you can compute it easily. And if you don't know how to compute earnings, you take your revenues less your expenses times your tax. Okay, and that would give you your net operating profit after tax. 1 minus T. And then over on the right is another way to do it. So your changes in current assets and current liabilities is your change in net operating working capital. Then you look at your that's step 2, and step 3 is that net operating working capital plus your investment in operating assets is your total operating capital. Then you look at your change in that. You look at your net operating capital for 1 year, subtract last year's, and that's your net investment in operating capital. And then you put that over here. So you take your NOPAT down here, and then over on the right, you bring in what your change in investment operating capital was, and that's your free cash flow. So it's essentially your earnings. Okay, it's your earnings minus that investment in capital needed. Okay, the difference is free cash flow. And so that's why I showed you a financial statement, because I need to see a financial statement to make the adjustments needed to calculate free cash flow. So this shows you the calculation and using the numbers that I showed you in the financials previously. The question here is, how do you suppose investors reacted? Because notice what this number is. It's negative. Okay, you want that to be positive. Very badly you want that to be positive. It's negative by $1 million. So you can just imagine what the investors said. They're like, this is not good. Something must change. And clearly it's negative. Their NOPAT was a small positive before interest and tax. It was a very small positive. They had a huge investment in operating capital, over $1 million investment. So I have a negative cash flow. Now, you want that to be positive. However, if you could explain to your investors that, we made this investment for future growth opportunities, this is what this was expected, that might be legitimate. We don't know enough about the company to know if that's really the case. I will just tell you, you typically want this to be a positive, and everybody should know that. So this just shows you for this particular company then where their free cash flow went. After tax interest payments, increase in principal, increase in debt, payment of dividends, and then they sold off some short-term investments to gain some more cash. And so that's my negative $1 million. So most of it just went to taking on more debt. And then this just shows you how to calculate the NOPAT, net operating profit after tax. EBIT times 1 minus T is your NOPAT. This is 16 means the current year, 15 was the prior year. Clearly a big drop here. That's never a good sign either. Okay, so some of those measurements that the chapter talks about, is NOPAT, and I'm making you do some NOPAT and some free cash flow calculations for that Excel file. Another big one that the chapter mentions is EVA, economic value added. And it's a way to try to figure out how much value did we add to the company by taking into account the cost of capital and the capital used to compute, to basically come up with those earnings. So WACC is the weighted average cost of capital. We've looked at that concept. I forget what chapter it was all of a sudden, but we've looked at that chapter before, or looked at that concept before. It's basically the cost of all the company's different sources of capital weighted against each other and averaged out. So typically for most companies, it's some portion of debt and some portion of equity, equity being either common stock or preferred stock. So it's the weighted average of all of those together. So your EVA is your NOPAT minus the cost essentially to earn that net operating profit, which is your WACC percent times the amount of capital that you have invested to earn that NOPAT. So that's your EVA, economic value added. That's not an accounting term either. It's just something we only look at in finance. And if you can recall the calculation, I think we've looked at this previously. It's been a while, but you are going to do some calculations like this one right here for the Excel file, so it's important that you know it. And I should mention too that I think I've given you maybe 2 other Excel files in previous weeks, and some of those I gave you some structure with how to do that. And I didn't really do that this time because all the answers are just kind of filling out a formula. Okay, it's just basically saying just as long as you know what the formula is, you can pretty much just drop in numbers with that formula and solve for it. Okay, so kind of just remember these formulas I've been showing you will be used quite a bit then for that Excel file. So here's the EVA calculation for 16. Their cost of capital was 10%, so it's that 0.1. My NOPAT, that's after the tax effect and everything, I get a negative 215. I had a positive in 15. Now it wasn't hugely positive, but at least it was positive. It was 11.6. Let me just show us some other data about the company, just to show you the impact of having negative cash flows. Your stock price would go down. We didn't issue any new shares this year. Earnings per share goes from a positive to a negative. That's never a good sign. The company cut their dividends in half. I would have argued they probably shouldn't have paid dividends with that large of a negative cash flow, but they cut them in half. Okay, then another measurement term to say how did my company do is called market value added, MVA. It's the market value of the firm minus the book value. And so market value is the number of shares of stock times the price per share. So however many numbers of shares of stock are floating around, we take those shares, multiply it by the price per share, and add the value of debt. That's my market value. Book value is looking back at my balance sheet and going, what's my common equity and what's my debt, adding those two together. And so we'll do a sample here in a bit. And so if the market value of the debt is close to the book value of the debt, then the MVA is just simply market value of equity minus book value of equity. Okay, and that's usually pretty common with debt. The market value of it and the book value of it are typically pretty the same. So here's my calculation then for MVA for 15 and 16. You can see here how they came up with the numbers. MVA in 16 was a small positive. In 15 it was a very large positive. And you want this to be positive because it's a measurement of management's performance. The higher the MVA, the more value that management has added to the company by making decisions about its operations and things like that. Next we get to residual income in EVA. And you can see there's a few slides about that. Techniques for overcoming errors in accounting measurements of performance. So remember that accounting is about recording revenues earned and expenses incurred, whereas economic or finance and economics is more about what's the true value of cash. What's the valuation of cash flow produced. And so in finance, we're looking at things from a cash perspective. In accounting, we're not, as strange as that might seem. This emphasizes NPV concepts and performance evaluation over accounting standards. So if you can recall, we talked about NPV quite a while ago, roughly week 3. Okay, looks more to long-term and short-term decisions and more closely tracks shareholder value than accounting measurements. So essentially it's finance people saying we need to value a company, and accounting records we know do that. We'll look at them, we'll use them, but we're going to change it up a little bit to fit the calculations for our needs. So this gives us an example of that. Quail City subduction plant, this is in millions of dollars. We have some sales, cost of goods sold, selling, general administrative expenses, and then we get to $200 operating profit minus tax, net income of $130. Okay, so that's more of an accounting look right there. Assets right here, net working capital, property, plant, and equipment, subtract out depreciation, my net investment, and my other assets and total assets. My net investments, I should say. Net investment is 1160 minus 360 is 810, so net investment in property, plant, and equipment. And so what I do then is I calculate my ROI, return on investment. Okay, and that's using the accounting numbers. That's using, going back here, looking at that 130 of net income. Okay, and then we're dividing that by my total assets of 1,000, and I get 13%. But however, what I do is I have to back up what they say the cost of credit, or you could look at the WACC, call it that too. Subtract that 10% and we get 3%. So my net ROI, once I back off the cost of the capital I needed to earn that 130, is 3%. 13 sounds really good. 3% is like so-so, right? So residual income, or EVA, then is a net dollar return after deducting the cost of capital. Okay, so EVA is residual income minus income earned minus income required, and income earned is minus my cost of capital times my investment. So we've already looked at this bottom calculation we've already looked at. So I do that for this company. For our Quail City plant here, we got the 30 million. And so my economic profit then is my capital invested multiplied by the spread between return on investment and cost of capital. So EP, economic profit, ROI minus the R times capital invested. Okay, so I get to 13%, the ROI, minus the 10% cost of capital times capital invested of $1 million, and I get 30 million. Okay. So EVA then, it says here, managers are motivated to only invest in projects that earn more than they cost. EVA makes cost of capital visible to managers, and it leads to a reduction in assets employed. EVA does not measure present value. It rewards quick paybacks, ignores time value of money. So there's 3 pluses here and 2 minuses. So the 3s are the things that are good for EVA. The bottom 2 are things that might be a drawback of EVA. Okay, because EVA does not take into account present value. Rewards quick paybacks because it ignores the time value of money. However, the good typically probably outweighs the bad. You only want to invest in projects that earn more than they cost. And I would just say as students in a master's program taking a finance class, to me a takeaway that you have as you finish the class, which we'll be doing here in the next couple of weeks, is look back and go, what did I learn? You know, what's the big takeaway? And to me, one of the big takeaways should be, how do managers make decisions to increase the value of a company? Okay, and then how do you make those decisions? How do you identify the opportunities to do so, and how do you measure if we really did that? You know, that's a lot of what we've been talking about. But essentially, just think, the takeaway to me is, how do I make decisions to figure out how to make the company worth more? Okay, and that's what, you know, EVA is a measurement of that. And so it encourages you to invest in projects that earn more than they cost. That sounds like a good idea, right? Makes cost of capital visible and leads to a reduction of assets employed. So we might be more efficient in how we employ the assets of the firm to earn revenues. So another example of EVA, it says here, a movie producer is generating $30 million in net income during a 4-month run of a movie called The Revenge of the Finance Professors. That'd be a terrible movie, by the way. Movie rentals and post-theater income is forecast to be nominal. So in other words, not much income after that. So basically the revenue and the expense from that will be almost the same. The cost to produce the movie was $100 million, given a 10% cost of capital. What's the EVA of the project, and was it a good investment? So they come up with essentially an EVA of $20 million, which sounds great. However, they give us kind of a point here in saying, well, EVA is positive. The movie industry highlights a major shortfall of EVA. It ignores the fact there's no long-term benefit that accrues to a movie, because essentially what we're saying is in that 4 months we'll earn the $20 million. And after that, we really get almost nothing. For this particular movie, they're saying the residual income will be hardly anything compared to the expense to generate that residual income. Now, other movies and TV shows can make money for a very long time, but they're saying this one will not. The title does not help, obviously, right? So basically, they're saying that this project is a loser despite the high-quality subject matter. So it's the author of this trying to have a little bit tongue-in-cheek there. So then just accounting measurements and rate of return then. It says cash receipts plus change in price divided by beginning price gives you what they call an accounting return. That could be for anything. So revenues plus change in price divided by beginning price is rate of return. Economic income, though, is cash flow plus change in present value. So that's a better measurement, because present value is a very important concept in finance. And then that second point here, that's a very important, because now I'm using present value techniques, and I will have a much better, much more representative rate of return calculation than without using cash flow techniques. So this just shows you accounting measurement, an economic look versus an accounting look. On the left side, the economic look, which is more along with the finance stuff. Cash flow plus change in present value equals cash outflows. Cash flow minus depreciation. On the right hand side, we look at cash flow plus change in book value. Remember, the change in book value has nothing to do with true value. Then we subtract out depreciation. So left hand side takes time value of money into account. The right hand side does not. And so economic income is your present value at the start of the year. Accounting income is the book value at the start of the year. So both are meeting different needs. Think of it from that perspective. And so there's legitimate reasons that they're different. We just have to know that they are different, why they're different. And if I'm looking at accounting, I'm going to look at accounting stuff. If I'm looking at more finance and economics, I'll look at the stuff on the left. So it's just more a matter of trying to understand what you're measuring and using the right concepts to do that. Okay, so for this week, there's 3 assignments, just as a reminder. A discussion board post with 2 questions, a 10-question quiz, very similar to the previous quizzes I've given you, and then that Excel assignment. So open up that Excel file. There's 5 questions, crunch the numbers, use some of the formulas and examples from this PowerPoint. Once you feel like you've got those 5 Excel questions answered, then go open up the Excel quiz in Blackboard and just choose the right answer. You've got the 5 questions, each has basically 4 options for you to choose from. Watch the numbers closely when you choose the right one. Some of the numbers are close to each other on purpose to make you pay attention. But so I'll just kind of give you that warning. Just make sure you're choosing the exact right number, because they are worth 5. There's 5 of those questions that are worth 5 points each. As always, if you have questions, please let me know. I'm more than happy to help you out. Thanks.